This is our Unit 3 seminar in the GB 519 Measurement and Decision Making, and we're covering chapters 5, 6, 8, and 9. It's going to be a very sort of overview of what we're going to be talking about. We're significantly changing direction in our discussion in weeks, starting in this week and then moving forward. So we're talking about budgeting. Okay, so budgeting is an extremely important part of an organization. And I will tell you from personal experience is that the budget manager is one of the most important people in an organization, but actually one of the most hated people within the organization. Because this person, whether being male or female, he or she essentially is there to say, no, you can't spend this money. And you're not generating revenue the way you're supposed to be doing. So this person is generating all this sort of bad vibes, but you got to have that person there that sort of forces people to stick to the budget. And if that person is not there, then things can really go haywire. But if that person is there and he or she is doing his or her job, he or she will be not the most popular person in the organization. But does that mean that senior management doesn't appreciate this person? No, absolutely not. They're looking for a person that actually will sort of put their foot down and say, no, you can't spend this money. You got to stick within the budget. So as we go through this discussion, kind of think about this human element related to budgeting. And I always love to relate this experience, and hopefully I won't relate it more than once within the semester. Working in industry and working very closely with the budget department as the audit director, we had a meeting with one of the vice presidents of the organization. And the budget director, as was appropriate, said, no, you can't spend this money. And the vice president just started crying, and it was the most amazing thing. She basically acted like a spoiled 14-year-old girl that would not accept no as an answer. But the budget director stuck to his guns, and she kept crying. She actually left the meeting. But that's how hard budgeting is. That's really how hard budgeting is. I will not respond to that comment, Stuart. That's but yeah, I mean this budgeting is, like I said, is so unbelievably important within an organization. And having someone that understands this and has the fortitude to actually stick up to what is important doesn't make him or her popular. There's no question about that. But makes that person so unbelievably important within the organization. And there will be people that actually recognize that and will support this person. So I'm just kind of relating this from a very personal perspective, and like I said, budgeting extremely important. Okay, so why is budgeting important? Well, budgeting is important in terms of planning, and we use this term master budget, and we have an operating budget and a cash budget. One of the interesting things related to the process of sort of cash versus what's taking place in the organization is the fact that cash tends to go out much quicker than it comes in. So what are we talking about this? Well, employees need to be paid every 2 weeks, and you absolutely got to have your payroll money there to pay employees. If you don't have that, you're pretty much done as an organization. So you got to have that. That happens every 2 weeks. You got to pay your vendors. If you don't pay their vendors, they're going to get angry, and in fact, they will come back to you and basically say, yeah, we're not going to do business with you. So you got to pay your vendors. But the problem is your customers are not necessarily paying you at that rapid pace. So while you may be paying all of your bills basically immediately or within 10 days or 15 days, is your customers may be paying you back on an average of 40 days. So you have that gap in time from the time that you're actually spending the money to the time that you're actually receiving the money. And this is basically the whole problem related to a cash budget, is that gap in time related to when the money comes in and when the money goes out. Budgets can be completed either top down or a bottom up. So a bottom up basically is everybody sort of presents what they need in terms of supporting their department, and it goes up. Top down approach is basically saying we got to shave our budget by 10 or 15%. Executive management sets out strategies to guide the company's action. The budgeting process translates that strategy into action by allocating financial resources across the organization. And this is exactly what takes place. Is senior management essentially is presenting this sort of global strategy in terms of where we need to be, what markets we need to be, what capital projects we need to complete, all these things. All good stuff. No question about that. And that's what they're supposed to be doing. The budget guy or budget gal sitting in the background with with their Excel file is now trying to translate what this person is saying in terms of making sure that we're actually doing what we're supposed to be doing, number one, and also in terms of making sure that there's enough cash to support what it is that we're trying to do. Overview of what we're talking about. What I want to talk about now is some very, very specific things related to budgeting, and most of the budgeting work that we're talking about is related to manufacturing. So we're going to use a number of terms in terms of direct costs, variable, direct labor, direct materials, and overhead. In terms of manufacturing costs, we're going to look at this from the perspective of product costs. In other words, costs that essentially become attached to the product. This product becomes part of inventory, which is a balance sheet item, until it's sold. And then only when it's sold, it becomes cost of goods sold, which is an expense. And there are also, in a manufacturing environment, period costs. So these are the costs that essentially are expensed in the period in which they're incurred. So primarily we're talking about there is costs such as accounting, sales, and administration, and so forth. So what we really need to understand is, if you read through the detail of this slide, that's exactly what we're talking about in terms of understanding the manufacturing component and then understanding the support. Now the support in terms of general marketing and administration are all period costs, but the product costs are the things that essentially become absorbed into the product that we're manufacturing and stay there as part of inventory until they're sold. And when they're sold, they essentially then become our cost of goods sold. So we talked about our cash budget. We made a couple comments related to that earlier, but essentially the cash budget is what we're attempting to do is attempting to understand the cash requirements of the organization as it moves forward. And again, we got to pay our bills. We have these major things. So maybe we have a bond that is due that's 5 years. We have to pay $10 million to pay off this bond. Well, what are the strategies that we have in terms of accommodating this? I am the treasurer of our the building that we live in. It's a cooperative here in Manhattan, and essentially my concern is from a cash budgeting perspective is making sure that we have sufficient reserve for any contingencies. So I'm of the opinion in my building that I believe that we should keep a contingency cash for capital reserves and other items of about $1 million. Okay, so that's the target. So the question becomes, well, how do we actually reach that target? Given the fact that, in the process, we're actually spending money, money comes in and so forth. So what we're attempting to do is understand, and you see here our short-term needs. We also need to understand our long-term needs related to cash. And I just can't overemphasize how critical this function is to an organization. Because the absolute worst thing that could ever take place in an organization, and happens all the time, but if you run out of cash, you're pretty much dead. There's not much you can do here. Okay, so we're going to sort of move to a budgeting directly related to manufacturing. So the next couple of slides, we're talking about manufacturing, and we're talking about manufacturing from the perspective of manufacturing products. And the product essentially includes our direct labor, which are the people that are actually manufacturing the thing. We have direct materials, which essentially is being attached to the thing that we're trying to manufacture. And then we're using the other term, which is overhead, which is like the shopkeeper, maintenance, service. But again, we're talking about the manufacturing piece in terms of everything that's required to manufacture this product. Now, from a budgeting perspective, and I will tell you, I've got a couple of videos, and I'll get these out to you tomorrow related to budgeting. But the idea in terms of budgeting is we are using what's called a flex budget. So let's just sort of talk about the flex budget in terms of how this relates to a manufacturing organization. So the budget essentially is developed at the beginning of the year, actually before the beginning of the year. And the starting point of the budget is where the sales group basically says, yep, we're going to be able to sell 1 million widgets. Okay. So based upon the fact that they're telling us that they're going to be able to sell 1 million widgets, is we develop a budget for manufacturing to manufacture 1 million widgets. Okay? Now, the issue becomes is that we may actually sell 1.5 million widgets, or maybe sales was actually didn't do their budgeting correctly, and we only sold 600,000 widgets. Well, the difference between what we were supposed to sell versus what we actually sold is the responsibility of the sales department. And when we talk about budgeting, we talk about budgeting from the perspective of making sure that we assign responsibility appropriately. So as an example, if we only sell 600,000 widgets and we were supposed to sell 1 million, does that mean that all things being equal is that the manufacturing department is now 40% under budget? And the answer is no. And the way we actually do this is within what we call a flex budget. So a flex budget essentially is this budget where that it assigns responsibility. So if we were supposed to sell 1 million, we only sold and manufactured 600,000. That 400,000 widget difference is the responsibility of sales. Has nothing to do with manufacturing. So we now flex the budget for manufacturing down to the 600,000 widget perspective, and then define how the manufacturing department actually met expectations based upon budget, based upon the actual output of the 600,000 widgets. Sounds a little complicated, and it is. Actually, it's very complicated, but that's what it is. Okay, so we have basically three different areas. So we have direct materials. Essentially, is the direct material that is attached to the final product. Direct labor are the people that actually work on the product, basically create the new product based upon raw materials. And we'll talk about overhead in a few minutes. Now, I do have a video related to this. I'm not going to sort of extend the conversation too much related to this. But you notice on the right side, we have the flex budget. So the flex budget essentially is the flex point. So the idea is that if we were supposed to sell 1 million, but we only sold 600,000, essentially from the manufacturing perspective is that we flex the budget based upon 600,000 units as opposed to 1 million. So you notice the first item here is the actual quantity, AQ, actual quantity. So the actual quantity used essentially becomes sort of this focal point of what we're attempting to do. Now, on the other side, on the left side, we have actual quantity times actual price. So what we're attempting to do here, and again, listen to the video that I have that I'll provide the link tomorrow, is what we're attempting to do is, so the actual results are what they are. Okay, so the actual results are we manufactured these items, and we're looking at labor costs here, and the labor cost was this. Okay, that is what it is. But what we're actually able to do in a budget perspective, which is fascinating, it's not easy to kind of comprehend, but it is fascinating once you get that point, is based upon the flex budget, based on the fact that we only had to manufacture 600,000, is we're going to determine whether or not we had a variance based upon price, and in this case, materials, the price per yard or per gallon or whatever, versus the actual quantity. So in this flex budget perspective, we're actually able to differentiate pricing versus quantity, which is fascinating. I mean, I think, once you kind of get this, it's actually very good. Same thing with labor. So we're actually able to differentiate is, did we actually pay the people too much or not as much as we had budgeted? And then the efficiency is, did they actually work more or less to manufacture the product that they actually manufactured? And that's the whole purpose of the flex budget. And again, and then we have the overhead variance. Overhead variance is kind of interesting in the sense that it's kind of think about overhead, as an example, the lease to the building. Okay, well, the lease to the building is, if you allocate that based upon the sales budget, you're allocating this, again, back to that million units that we were supposed to sell. Well, we already talked about the fact that we only sold 600,000. So allocating this fixed budget is what we're able to do is take a look at the differences between the overhead spending variance and the overhead efficiency variance. And again, I'm not going to get too much in terms of detail, but if you watch the videos, I think you will gain some insights related to this. Okay, so we talk about here the overhead, actual overhead minus the budgeted. Okay, it identify potential causes of variable overhead spending and efficiency. Maybe we've paid more or less for the variable overhead items. Variable overhead efficiency results from using an activity based more or less efficient than allowed. And again, I'm not going to spend a lot of detail on this because you will actually see. So what we're looking at here is actually, so the question becomes, well, why are we doing this? We're doing this for decision-making purposes. Okay, so we clearly want to identify the relevant information. We want to make sure that our costing information is actually tracking what's actually taking place. And we've used this term before, and I'll just kind of throw this out again, is activity-based costing. Well, activity-based costing essentially is tracking the cost, but also tracking the cost driver. And the cost driver may be a function of our volume, but it may also be a function of other components. And what we need to do is to be able to identify those components. So all of this becomes relevant information in terms of making decisions. Special order pricing, so the issue becomes, okay, so a special order comes in, should we accept it or not accept it? And the answer is it sort of depends, and it's going to depend upon our variable and fixed costs related to this. What's interesting is, from a political perspective, I'm sure everybody's been following all the discussions related to, okay, should we bring everything into the United States? Should we, create barriers to prevent the manufacturing from leaving the country? And the issue becomes is that ultimately, all decisions related to where things are going to be manufactured, in other words, whether they're going to be manufactured here, or in another country, or in another set of circumstances, is we are going to be doing a significant cost analysis. And we're going to decide, should we outsource this or should we build it in-house? And the tools that you are going to learn, that you're learning in this course, are the exact same tools that people use in terms of deciding, should we close this plant and move it to Mexico or Vietnam or China or whatever, or should we keep the people here and do the manufacturing here? So the whole outsourcing from an accounting perspective is pretty straightforward. Now, you clearly have to understand the political and social and other implications of your decisions, but in terms of a mathematical model, the stuff that we're talking about in this class is exactly the kind of stuff that people use to make decisions of, should we close our plant in the United States and then move it elsewhere? Constrained resources, so we have limited resources, personnel, maybe skilled workforce, whatever. This is all kind of important stuff. And then this whole issue, which is kind of sort of part and parcel to the outsourcing piece, is should we keep or eliminate operation? The takeaway on this, and I just can't overemphasize how important this class is. And again, the mechanics of it, very, very difficult, but I want you to kind of go beyond that and sort of think sort of global, real world, big picture items. The kind of stuff that you are exposed to in this class are the kinds of things that organizations use to make really important decisions related to what should be taking place within a global environment. This is kind of neat. Okay, so just very briefly, we've talked about time value of money issues, which I'm sure you've been exposed to in other classes. And so time value of money, we think about an annuity where it's principal and interest. And then We have this bottom piece here related to payback period and accounting rate of return. Okay. Those are the kinds of things that I'm sure you've talked about in other classes, and we just kind of reintroduce those here. So we want to identify the cash flow associated with capital budgeting, which, by the way, we want to make sure that we make a distinction between capital budgeting versus operations. Capital essentially are the long-term projects, and what we want to make sure is that we actually have the cash available when the decision is that we actually do these projects. Some more information related to annuities and present value. I'm not necessarily sure that we should spend the time over here. Make sure you're spending some time in terms of understanding what your case study is. Unit 4, we have the case paper is due, and I believe in the next section is you're actually going to be doing the presentation of the case study. So it's basically the same thing. So you should be reviewing the assignment now in terms of what it is you're required to actually do. So there we are. We're at the end of the session.